Yeah, what makes common stock prices so hard to predict is that a general liquid market for common stocks creates from time to time, either in sectors of the market or in the whole market, a Ponzi scheme. In other words, you have an automatic process where people get sucked in and other people come in because it worked last month or last year, and it can build to perfectly ridiculous levels, and the levels can last for considerable periods. Trying to predict that kind of thing, sort of a Ponzi scheme, which is, if you will, accidentally thrown into the valuation of common stocks by just the forces of life, by definition, that's going to be very, very hard to predict. That's what makes it so dangerous to short stocks, even when they're grossly overvalued. It's hard to know just how overvalued they can become in addition to the overvaluation that exists. And I don't think you're going to predict the Ponzi scheme effect in markets by looking at the price of gold or any other correlation.
Charlie and I mean, you're pulling a figure out of the air. We have probably agreed on at least 100 companies, maybe more, that we felt were frauds, you know, bubble type things. And if we'd acted on shorting those over the years, we might be broke now. But we were right on probably just about 100 out of 100. It's very hard to predict how far what Charlie calls the Ponzi scheme will go. It's not exactly a scheme in the sense that it isn't concocted, in most cases, by one. It's a sort of a natural phenomenon that seems to nursed along by promoters and investment bankers and venture capitalists and so on. But they don't all sit in a room and work it out. It plays on human nature in certain ways, and it creates its own momentum, and eventually it pops. You know, and nobody knows when it's going to pop, and that's why you can't short. At least we don't find it makes good sense to short those things. But it is recognizable. You know when you're dealing with those kind of crazy things, but you don't know how high they'll go or when it'll end or anything else. And people who think they do, you know, sometimes play in it, and other people know how to take advantage of it. I mean, there's no question about that. You do not have to have a 200 IQ to see a period like that and figure out how to have a big wealth transfer from somebody else to you. You know, and that was done on a huge scale, you know, in recent years. It's not the most admirable aspect of capitalism.
Mr. Munger, this morning while discussing index funds, you used the example of Japan as a real example of poor performance of a major index over a long period. Indeed, the S&P 500 index declined over 60% in real terms from the early 60s through the mid-70s. Could you discuss the mental models you use to consider the impact of inflation or deflation on your investment decisions and the likelihood of either occurring over the next decade?
Well, that's partly easy and partly tough. If interest rates are going to go way up, you can obviously have a lot of deflation of stock prices. And a lot of that happened in the American period you're talking about. What's interesting about Japan is that I don't think anybody thought that a major modern Keynesian democracy pervaded by a good culture in terms of engineering, product quality, product innovation, and so forth, could have a period where you would have negative 13 years without major depression either. I think that and that it would occur while interest rates were going down, not up. I think that was so novel that the models of the past totally failed to predict it. But I think these anomalies are always very interesting. And I think it's crazy for Americans to assume that what's happening in Argentina and what has happened in Japan are totally inconceivable forever in America. They are not totally inconceivable.
You had a huge bubble in equity prices in Japan, and now you've had interest rates go to virtually nothing. You've had the passage of time. The country hasn't disappeared. People are going to work every day, and you've had the Nikkei, now at a third of what it sold for not that many years ago. It's an interesting phenomenon.
And huge fiscal stimulus in the whole period from the government.
Post-bubble periods, I think, depending on how big the bubble is, and how many were participating in it, but post-bubble periods, I think, can produce fallout that not everyone will be terribly good at predicting.